Hey, welcome to another Ultimate Edge webinar with us. And thanks for joining, guys, this time with Tom Howell. Tom's been with us before, so he might not need further introduction. A lot of people know you, Tom, but take some time and just give us a little bit about your background on this particular webinar, please.
Okay. Well, I've been a tax accountant for 30 years and an enrolled agent for most of that. Outside of that, I've been a very active real estate investor for 20 years, although I took a few years off here after the big crunch. And so I'm getting back into the game in a big way. And so I love to teach the power of real estate to build retirements and to save on taxes.
And before we leave that, tell us what an enrolled agent is for those people who are not familiar with that term.
Enrolled agent is a certification granted by the Department of Treasury, which is a federal agency. So my license is federal. A CPA is licensed by the state for accountancy. Accountancy doesn't necessarily mean tax. So EAs are all tax and a little accounting. CPAs are all accounting, and most of them have good tax.
Talk about mortgage debt, which is really an interesting topic and something obviously near and dear to my heart, because that's what we do here, is provide people with mortgage debt, which can either be wonderfully good for you or wonderfully bad. I guess maybe wonderfully bad may not be the right way to phrase that. Can be bad.
Right.
And guys, Tom his goal in life is to optimize debt so he minimize risk and get the optimum yield on a project. And with that, Tom, why don't you just take it over and tell us what we're going to talk about today, please?
Okay, so we're going to talk about debt primarily for investment properties. So there's a different set of rationale for how you finance a personal home, and there's a second set of formulas on how we calculate investment debt. So what we're going to talk about today is investment debt. The first thing I need to talk about, and the thing that actually drives all of our decision making, has to do with what we call the break-even formula. And it looks complicated, but it's really rather simple, and it's this. The rate of return from your investment portfolio has to beat the rate of inflation less taxes. Does that make sense?
Yes, that makes sense.
So in my example here, if we had aggressive inflation and a 30% tax rate, the first 8.5% of what you earn on your portfolio is only keeping pace with your inflation. So if we measure inflation by how many bags of groceries you can buy in a year, 20 years from now, we want your income to buy more groceries, not less groceries. And the only way to do that is to beat the rate of inflation with the break-even formula. So there's two components that matter to me. One is how you invest. That's the investment return. The second piece is how do you minimize the taxes so that what you do earn goes farther along. And if anyone has learned the rule of 72 and compounding interest, the more money that we can make year after year after year on top of each other is what brings us to the large level of wealth that real estate can bring us.
Okay, Tom, before you leave this slide, I do have to ask where you came up with the number for inflation there. You note on the slide there, the U.S. government says 2%, and that's what we all hear in the news, but Shadow Stats says 8%. What's the difference there?
So the government doesn't count energy or food in their math. It's also skewed on purpose a little light. Some people would have a conspiracy around all of that. But the government tends to say that the inflation is low enough so that they don't have to raise interest rates. They don't have to give people large cost of living adjustments to Social Security. So the IRS or the federal government tends to keep inflation low. There's actually a website out there that has some good rationale on why they believe true inflation is 8%. I picked 6 for this example, but you could pick 4, 3, 2, whatever you're comfortable with. I can tell you that at a 4% inflation rate, your rate of return still has to be 5.7%. So,
right. Okay.
So at any time you have to beat inflation with your investment portfolio.
Okay, well, it makes sense. We're not sure what number we want to target here, but I can see where you're coming from. So given those two data points, U.S. government and Shadow Stats, inflation right now is probably around 6% is what you're thinking, real inflation.
Yes. If you use the Shadow Stats rationale and look at energy costs going up and down, the food costs going up and down, when you look at a portfolio over 20, 25 years, you have to think about where are things going to go over the next 25 years. Exactly. And we've seen, just think what gas prices were 25 years ago. or food prices 25 years ago.
Yeah, I mean, that's got to be a little bit of a surprise to people, just knowing that the U.S. government doesn't include energy costs in our inflation calculation, because they're significant, and so is food. That's amazing.
And so is food. So they don't take those two things into account. So
Okay.
most people have a pretty good understanding of how much of their paycheck goes to keep up year after year after year.
Yeah. So second question for you, the tax rate is 30% in this example. About what income level is that in 2020, Tom?
Well, that may not be as high as you think. Probably about $100,000.
Okay.
And particularly if you're in a high tax state like California, they have 8, 9, 10% tax rates that they add on to the federal rate. So even if you were 20% federal, 10% state, you have a combined 30%.
All right. So these are real numbers, guys, that Tom's talking about here that applies to a lot of people then. Thanks, Tom. And let's keep on moving.
Okay. So next we want to talk about why do we use leverage? And I have a couple of examples that we'll have to follow through. But the first example is simply buying a home all cash or paying your house off. If your house is paid off, people feel like that's a good idea, and I can show you why it's not. So in my example here, we have a house that we bought for $200,000 all cash. It makes $1,500 a month rent, $18,000 a year. We don't have to make any debt payments, but we do pay taxes, insurance, repairs, vacancy, and so forth. So our operating costs on that house are $6,000 a year. If we assume a 4% appreciation rate, which is pretty modest for the Seattle area, we've been running double digits at times over the last few years. We average about 6 to 6.5 long term. So 4% is pretty light for Seattle, but that's probably more accurate for the rest of the country.
Okay, fair enough.
Right? So here's what the results are when we buy this house all cash and we're receiving $1,500 a month. Oh, never mind. I did my slides out of order. This is actually part B. Here we're buying a house with mortgage. We're buying the same $200,000 house, only this time we're putting $50,000 down. We're getting a 5% 30-year amortized loan. Our payments would be $523.34 a month for just the principal and interest. We have that same rental income of $18,000. Our operating costs are the same at $6,000, and we still appreciate at 4%. What we're measuring is the percents of return and the percents of appreciation.
Yeah. Okay.
And so as long as the percentages stay the same, the results will be the same regardless of the price of the house we start with.
Okay. Fair enough.
Does that make sense?
Yeah.
So here's the results of this. Column A is that example. We had no debt. We bought the house all cash. And if we follow it down, we have a down payment of $200,000 that we sent to escrow, no mortgage. We make $18,000. Out of the $18,000, we pay the $6,000 in expenses for taxes, insurance, vacancy, repairs. We have a net operating income of 12% or $12,000. That calculates to a cap rate on that property of 6%. So our $200,000 house is returning a 6% cap rate. Using a 4% appreciation, the value of our home in 7 years becomes $234,608. So what we calculate is an internal rate of return, which takes into account not only the cash flow that we receive, but the appreciation that we receive based on the value of the money that we put into the transaction. So for column A, we've made an 8.897% return on our $200,000. That in itself is not too bad. That would beat most mutual funds.
Yeah, exactly.
Right? But here's what happens when we use debt. Column B, we bought the same $200,000 house, this time using $50,000 down payment, took out $150,000 mortgage. We bring in the $18,000 in rent. We pay $6,000 in expenses. We also pay $6,280 in debt service payments for the year. So that brings our income down to $5,719. That calculation alone lowers our cap rate on this property to 2.86. And a lot of people would go, oh my God, I'm never going to buy a property with a 2.86 cap rate.
Right.
But what they're missing is this future value appreciation on their down payment. The house becomes worth the same amount in 7 years. When we do the internal rate of return calculation, because we only had to use $50,000 of our own money, we actually returned 20.627% on our $50,000. And the internal rate of return is going to blow out that break-even rate. So in column 1, assuming a 6% appreciation or 6% inflation, we would barely be making wealth. Our house would only be keeping up with inflation. But column B house, we subtract the 8.7% that we need for inflation, and we're still left with 12% growth of our wealth. And so to create the wealth that we need for future retirement purposes, we need to be making double-digit returns like the 20% return on that piece of property.
Okay, got it. Okay, Tom, a couple of questions here, of course.
Okay.
Cap rate is a fairly simple calculation, I know, but could you explain that to folks who are not familiar with calculation what cap rate is?
So cap rate is the annualized return on a property divided into the price of the property. So in column A, we made $12,000 a year in cash flow. We divide that into the 200,000 and we get 6%.
Okay. When
we only get $5,719 in cash flow and we divide that into the 200,000, our cap rate becomes 2.86%. Cap rate is more a measure of your cash flow out of a property, not the total return of owning the asset for a period of time. That's the internal rate of return calculation.
All right, so let's talk about internal rate of return and describe that calculation a little bit for us, please.
So now we're getting a little more advanced in the math, but what we do to calculate internal rate of return is we show that in year 0, when we bought the asset, we put $200,000 into it, and then every year we take $12,000 out, and in year 7 we're assuming that we're going to get our whole $234,608 out at sale. Of course, this is a simple example without closing costs and so forth. So along the way we put 200 in, we got 7 years of $12,000 out plus $234,000 out. So using Excel, we can calculate what that internal rate of return is on that 200,000.
What you're pointing out here is really a function of the leverage you have in the property because of the cash you have into the property and your rate of return out of the property.
Well, it's calculating not only the cash flow, but it's also calculating appreciation.
Yes, because that's part of your getting out. I get it.
Right. And when you do this calculation with Seattle real estate versus going somewhere in the Midwest, you would probably be better served to buy Seattle real estate than the Midwest, unless you are choosing to receive a higher cash-on-cash return and you're foregoing the appreciation.
Yep. So in your calculation here, you're taking into account appreciation, which does that mean that there are some investors I know that buy property with no intent to take into account the appreciation on the property into their calculation of whether they should buy it. It's all about cash flow, right? But you're saying that appreciation is relevant. Is that correct?
Appreciation is relevant. The problem you have is when if you're using appreciation to service the debt load on the property, that becomes dangerous because appreciation is it's not necessarily if you will get it, it's when you will get it. And so if appreciation is required for you to cash flow a property, you have too much debt. And that's part of the lesson here is how much is too much debt. It needs to only be based on cash flow.
Got it.
Value, usually when we look at the debt, which is on the bottom section of the house, you always have your first position note, the senior note. Usually that comes from a bank. You may have a second or a private note on top of that. Then you may also have some equity with partners, and you may ultimately have some of your own money into a property. And this is true for commercial properties as well as individual homes. So you may or may not have any one of those types of debt, but what I wanted to make clear was the higher in the stack you put your money, the greater the risk is to you, which is the reason the banks are always at the bottom, right? They're very risk averse. So the banks give you a great rate to take no risk. And that's why you can get a first position mortgage at a pretty affordable rate. And as you move up the stack, it gets more and more expensive.
Okay.
Right? Another piece of it at the very bottom, the little green pad of reserves. It's also very important that you always have cash on hand for the what if. And a lot of people they invest everything into the house without holding back enough money for reserves. And there's a theory that I put out there called the velocity of investing. You need to always be ready to get a loan and close on the next deal. In order, it's who acquires the most assets the quickest is going to be the wealthiest in the end. And if you get yourself in a position where you have no cash and no capacity, there are no more first position loans for you to get. And you and I have talked about that a little bit over time.
Yeah.
That staying liquid enough to always get that next mortgage and that next property when it comes along. And the good deals come and go so fast, you don't have time to sit and think. So if you're an active investor, you want to make sure you have lots of reserves for that safety margin.
Okay, so Tom,
everybody will tell you should have 6 months living expenses in savings, your emergency fund. It's the same thing in real estate investing. You should, if you have a tenant vacancy for 6 months, you should be able to survive through that with no problem. Yep. The only way to do that is to have 6 months of operating costs and debt service in your reserves.
Yep. The only thing I'm going to add to the equation then, for the regular financing or alternative financing or bank financing, you need income as well. So reserves are really, really important, and assets are really important, but cash flow, and in particular the debt to income calculation with your income guys, is equally important depending on what kind of financing you're going after here.
Correct. When we do the math on that, the maximum amount of debt that a property can carry, we're actually using a 1.15 debt coverage ratio, okay, so that we are always cash flow positive, and we're not making a payment higher than the cash flow can support, fully loaded with expenses. Okay. I like and then we still hold 6 months of those reserves.
Okay, very good.
And with that math, their income should be such that they should be able to just keep cranking away house after house.
Yeah, and with that math, as long as, so what fits into this conversation like a glove is that we have particular loans where the qualification for the purchase price or refinance of the home is completely based on the income on the property itself, unlike a lot of loans where we need 2 years tax returns and all of that. So that fits into this discussion really, really well. And Tom's using 1.15. We'll use 1-to-1 sometimes, which means that the income on the property needs to be enough to cover the principal, interest, taxes, and insurance on the loan for the property, and then you're good to go, as long as you have the down payment and reserves that Tom's talking about. So it fits really well.
Yeah. So then we talk about risks again. So here's the risks of having too little debt on a property. Having too little debt means we'll have a lower internal rate of return, and with a lower internal rate of return, we are creating less wealth. And wealth is what I consider is that remains after your living costs. So you would like to live on, $60,000 a year and make 100, 150, 200,000 on your portfolio, and you're gaining net worth over time. That's ultimately how we're going to get to retirement, particularly for trying to get retirement early.
Okay.
And then I talked about that lack of velocity in portfolio growth. If you have too little debt, your cash is all tied up in assets. It's dead equity, and it's just sitting there. We need to be able to pull out enough cash out of your assets that they're performing well and they're safe, but you're buying more assets with that excess cash. And then not having debt, you don't get to write off the interest. And that's one of the great tax shelter benefits of real estate, is to be able to produce a positive cash flow but a negative tax loss. And that's pretty unique to the real estate industry. And so too little debt is going to cause us to pay tax rather than save tax.
Okay, agreed.
The other side of that is if we have too much debt, now we don't have sufficient cash flows, particularly if a market declines. If we see rent fall down, if we see market values fall down, if for some reason our line of credit gets called at the bank, we could be at risk if we have too much debt. We also have lack of fundability. Your DTI may be suffering if you have too much debt, and now you can't get that second property, and velocity comes back into the equation. And with too much debt, you have much larger payments, and now we have a larger reserve requirement. So now we're tying up more cash in reserves, barely squeaking by holding the house. So we have too much debt. We're not being efficient with our portfolio.
Okay. Explain this, Tom. I think I know the answer myself, but why do you have larger reserve requirements when you have too much debt?
Assuming we're going to use 6 months as our number, if your payment is, $3,000, you need $18,000 in reserves. But if your payment's only $2,000, then you only need $12,000 in reserves.
Yeah, it's simple.
So we're tying up $6,000.
Yeah, and from a lending perspective, we look at that very, very closely. There are different ways we'll calculate it. but effectively what Tom said is right on. The more debt that you have, the more reserve we're going to want you to have as well.
Right. And it's all about getting our cash working for us and building wealth. That really is the ticket. And
you're probably moving this direction, Tom. Are we going to get some numbers here to kind of know where we need to calculate, how we calculate whether or not we have enough debt, too much debt, whatever?
We can. So here's the calculating the maximum level of debt. There's a couple of numbers that we need to calculate. One is the debt coverage ratio, and you mentioned 1-to-1. I like to use 1.15 for residential properties, and most commercial lenders are going to be 1.2 or 1.25.
Exactly.
So, right? So
yep.
We need to learn how to calculate that debt coverage ratio. The higher the ratio, the lower the risk is to the lender and to the debt. When we get to that number by calculating the net operating income divided by the amount of the payment, and that gives us our debt coverage ratio. Does that make sense?
Very good. Yeah. Yep.
Okay, so in my example, I have no less than 1.15. That's in a strong market. If you have a weak market or you think we're about to teeter into going backwards, you would want to raise that number. We also need to calculate what our break-even ratio is, and that has to do with our operating costs into our gross income. And with this number, we want the lower number is a better number. And oftentimes, 85% is a number a lot of lenders want you to have. So we're trying to buy assets in such a way that we're keeping the debt coverage ratio high and the break-even rate low. That means there's a lot of safety to the debt.
Okay, and clarify for us the calculation on the break-even ratio. I think that may be a new calculation.
And I probably need to do a different slide on this one because I think it's 20 minutes of conversation all by itself. But so I believe you should have a fully loaded NOI. And I mean by that, you need to take the income from the house and subtract vacancy, repairs, insurance, and taxes, and property management fee, even if you are managing that property. Yep. Because if you got hit by a car tomorrow, you need to be able to keep that house for your future paying a property management company. So that's extra money for you in the calculation if you do your own management. But the NOI should be fully loaded with all those expenses. And that whatever the NOI comes in after we subtract all those expenses, we need the debt payment to be no more than 85% of that NOI number.
Got it.
That gets us a 1.15 DCR.
Got it. Yep, they're related.
Now, when you look at Seattle real estate and the cash flow that you can get to it with the expenses that you have to pay, you're probably looking at 40% down payments to make this work. But that's where you really need to be for the ultimate safety. And where you make your money isn't so much the cash flow because of the debt you're carrying. It's the fact that Seattle's real estate is among the best in the country at appreciating. And just sit back and let the payments flow until that wealth is created. Autopilot is possible.
Yes.
Is we need to know that debt magnifies the return that we receive on real estate. If we use the correct amount of debt, as we just talked about, we actually have a very stable property. We're in a very low risk investment. It allows us to use our equity to acquire more assets. So instead of paying off that $150,000 mortgage and tying up $150,000 in cash, now you can free up $50,000 to buy a house every other year or every third or fourth year. And in 10 years, you have 4 houses appreciating and cash flowing rather than just one. And using debt correctly also reduces our tax burden, and reducing our tax burden is a key part of that break-even ratio that we talked about at the beginning.
And building wealth, absolutely.
And building wealth. So we'll go to these boot camps and these seminars and join the investment clubs to learn how to find an asset. And some people go further to figure out how to find private money and partnerships and so forth. The third part of this whole thing is how do you put the two pieces together in a capital structure that works? And that's the piece that not a lot of people talk about. And that's the piece that I'm trying to get more information out about. Almost any deal can be made into a good deal with the right capital structure.
Here's a question that popped up, Tom. Tom, if I own property that may have appreciated, you are saying that maybe I should take some equity out to go buy another property. Is that correct?
That's correct.
There you go, guys.
Every few years, you should look at whether you should be refinancing or adding a line of credit to keep the debt at the appropriate level on a property so you can pull that cash out and get it working for you, as well as that equity that you already have.
And for tax purposes or maybe other advice, how would they do so, please?
It's Tom at taxstreet, STREET.com.
Very good. And that's the best way to reach you, by email. Thanks, Tom, for your time. Appreciate it very, very much. We'll have to do this again soon.
Sounds good. Thank you.